One of the best job combinations for building wealth as a married couple is to have one person be a high W-2 income earner and then the other spouse be a real estate professional. The main benefit of having one spouse be a real estate professional is that they can leverage something called the real estate professional status, which is a special status designated by the IRS that can potentially allow both you and your spouse to pay $0 in federal income taxes on both of your income. So my wife and I have used this job combination for the last 3 years. I'm a software engineer in the Bay Area and my wife is a full-time real estate agent. And by filing our taxes together while claiming real estate professional status, we've avoided over $80,000 in federal income tax in 2022, $60,000 in 2023, and we're doing the same thing in 2024. I like to call this job combination the Shaq and Kobe combination because it's just an unbeatable job combination for married couples. Now, there are 2 qualifications for claiming yourself as a real estate professional. Number 1, you need to work at least 750 hours in a real property trade or business, meaning you work in one of these 11 categories defined by the IRS. And number 2, you need to work in that field of real estate more than any other job. So if you have another full-time job besides the real estate one, then you're not going to be able to qualify for this status. And being a real estate agent is included in one of these 11 fields, so that's how my wife gets to claim this status. So now let's dive into a case study from 2022, and I'm going to show you exactly how we saved $80,000 in taxes. In 2022, we purchased about $1.9 million worth of investment real estate. Now, remember, this only works for investment real estate and not for primary homes. Well, just like any other business, we had to report both the income and expenses related to our rental property business. So, let me show you how this works. If you look at this paper, this is called a Schedule E form. It's very simple. It basically just shows you the income and expenses related to each of the rental properties that we bought in 2022. So you can see from the top, there is the total rental income reported for each of the properties, column A and B. And then the majority of the remaining lines are different expenses within our rental property business. But as you can see on row 18, we have an expense called depreciation. And I talk about depreciation in almost all of my videos. So if you want to learn more about that, you can go and check out some of my other videos on my profile. Now, at the end of the day, what matters is that my business lost $389,000 in total when you tally up both the income and expenses for my business. That's what we call a passive loss. But the only problem is that passive losses can't be used to offset other forms of active income, like income from my job or my wife's job. However, there are multiple exceptions to this rule. So if you can claim real estate professional status, then you can qualify for this exemption, meaning you can use the passive losses from your rental property business in order to offset your active income. If you want to learn about the other exemptions, you'll need to read the IRS's article on passive activity loss limitations and just go on their website. So to bring it all together, we reported about $422,000 of combined gross income from our W-2 and 1099 jobs, and we offset about $389,000 of that from our rental property business using the losses. And when you throw in the standard deduction as well, we reported a total adjusted gross income of $6,300, and we paid $630 in total in federal income taxes in 2022, whereas we would have paid over $80,000 had we not used real estate professional status. Now, I forgot to mention one other requirement that we had to meet for this to work. It's called material participation. Obviously, you have to qualify as a real estate professional, so you need your 750 hours, and you need to go buy some rental real estate. But there's one last requirement where you and your spouse need to actually prove that you materially participated in your rental property business. Again, this is a term defined by the IRS, and essentially there are 7 tests if you want to prove that you are materially participating in your business. And you only need to pass one of the 7 tests. So in order to keep this video short and sweet, I'll just say that we use the test called the 100-hour test, which states that my spouse and I had to spend at least 100 hours and more than anybody else in our rental property business. So by qualifying as a rep, buying some rental real estate, and then materially participating in the rental property business, we were able to use the passive losses against our active income and then reduce our tax bill by about 99%. So it turns out the secrets of the rich are really not secrets at all. It's literally on the IRS website, and they explain exactly what rep status is and how to use it. And just to be clear, utilizing tools provided by the IRS in order to avoid taxes is what's called tax avoidance, and this is totally legal. However, if you report false numbers on your income or don't report income that you actually received, that's an example of tax evasion, and that is highly, highly illegal. The point is, everybody should strive to avoid taxes using legal methods and concepts provided to them by the IRS. The 401k is another one of those tools, as that reduces the taxes you'll pay on your income. Another strategy that is super popular with high income earners is the short-term rental loophole. It's an alternative to the real estate professional status method for individuals who don't have a spouse or who work in real estate full-time, right? So you're not going to be able to get real estate professional status. So the alternative is the short-term rental loophole, because it doesn't require you to have rep status, but essentially gives you the same exact benefits so long as you own and manage your own short-term rental business. And if you want a detailed case study of the short-term rental loophole, then you can use the link in the description below. I've created the most in-depth case study of the short-term rental loophole and how Henrys, high earners but not rich yet, can use it to lower their tax bill significantly. So if you watched this far into the video, I invite you to join the Henry Investor community. It's on the School platform, and I do live weekly calls with myself or a guest speaker. It's a place for a community and asking questions and gaining connections to other experienced investors, and you can find the link for that below as well. And hopefully you found this video helpful, and if so, then subscribe to the channel, and I'll see you in next week's video.